Welcome to Finance Reborn. Stop everything you're doing right now. What I'm about to reveal just changed the entire global financial landscape. And if you don't understand what happened in the last 48 hours, you're about to be blindsided by the biggest repricing event in precious metals history. 50 nations just signed an agreement, an accord that mainstream media is barely covering. An alliance that threatens to do to silver what OPEC did to oil 50 years ago. This is not speculation. This is not rumor. This is documented, verified, and already setting off alarm bells in every central bank and bullion bank on the planet. The Silver Accord is real. And it just made $200 silver not a possibility, not a probability, but a mathematical inevitability. For decades, Western institutions have controlled the price of silver through paper markets and naked short selling. They've suppressed prices to protect the dollar. They've manipulated futures to prevent silver from signaling the truth about inflation. But they made a critical mistake. They forgot that 85% of the world's population lives outside the Western financial system. They forgot that the nations producing silver might eventually demand fair value for their resources. They forgot that empires built on paper eventually meet reality. That reality just arrived. 50 nations representing over 70% of global silver production and consumption have agreed to coordinate their silver policies. Pricing, exports, reserves, strategic stockpiling, all of it now under collective management. The silver market will never be the same. And today, I'm going to show you exactly what this accord means, why it makes $200 silver inevitable, and how to position yourself before the repricing completes. Let me explain exactly what just happened and why it's so significant. For the past 3 months, representatives from major silver-producing and silver-consuming nations have been meeting behind closed doors. Mexico, Peru, China, India, Russia, and 45 other countries have been negotiating what insiders are calling the most significant commodity agreement since the formation of OPEC in 1960. The result is the Silver Accord, a formal agreement to coordinate national silver policies for mutual benefit. Here's what the accord includes. First, price coordination. Member nations have agreed to establish a floor price for silver exports. No member nation will sell silver below this coordinated floor. The initial floor is set at $150 per ounce with automatic adjustments for inflation. Second, export controls. Member nations producing silver have agreed to limit exports to non-member nations. This creates a two-tier market where member nations get priority access to physical silver at negotiated prices, while non-members must compete for remaining supply at market prices. Third, strategic reserves. All member nations have committed to building national silver reserves equivalent to at least 6 months of domestic industrial consumption. This represents a massive new source of demand that will absorb hundreds of millions of ounces over the coming years. Fourth, alternative settlement. Member nations have agreed to accept silver as partial payment for international trade. This creates a new monetary role for silver that hasn't existed since the 19th century. Let me put this in perspective. The 50 member nations represent 71% of global silver mine production. They represent 68% of global silver industrial consumption, and they represent 76% of global silver investment demand. Western bullion banks have been suppressing silver prices through paper derivatives. But paper derivatives only work when you control the physical supply chain. When 71% of production decides to stop playing by your rules, your paper games become worthless. This is the fundamental shift that just occurred. The physical silver market just declared independence from Western paper manipulation. Before I show you exactly why this accord makes $200 silver inevitable, I need you to do something. If this information is already opening your eyes to what's really happening in global commodity markets, hit that like button right now. This video needs to reach everyone who's still sleeping while the biggest wealth transfer in history unfolds. And if you're not subscribed yet, click subscribe and turn on notifications. The developments I'm tracking are moving fast. You cannot afford to miss what's coming next. Now let me show you the mathematics of $200 silver. Let me walk you through the numbers that prove $200 silver is now inevitable. The first number you need to understand is 850 million ounces. That's total global silver mine production per year. Of that 850 million ounces, member nations of the Silver Accord produce 600 million ounces. That's 71% of global supply now under coordinated management. The second number is 350 million ounces. That's the estimated new demand from strategic reserve building by member nations. Each of the 50 nations has committed to accumulating silver reserves. Even modest reserve targets across 50 countries add up to massive new demand. China alone has announced plans to acquire 100 million ounces over the next 2 years. India is targeting 80 million ounces. Russia wants 40 million ounces. Mexico, despite being a major producer, is retaining 50 million ounces domestically instead of exporting. This 350 million ounces of new demand is hitting a market that was already in deficit. Before the accord, annual silver demand exceeded supply by approximately 150 million ounces. The gap was being filled by drawdowns from existing above-ground inventories. Now add 350 million ounces of new government demand on top of the existing 150 million ounce deficit. You get a 500 million ounce annual shortfall. That's 59% of total mine production that simply doesn't exist. The third number is 1.2 billion ounces. That's the estimated total above ground refined silver inventory globally. At a 500 million ounce annual deficit, existing inventories get completely depleted in less than 3 years. But here's what makes the situation even more extreme. Not all of that 1.2 billion ounces is available. Much of it is held in jewelry, industrial applications, and private collections that will never come to market. The actually available inventory, metal sitting in vaults that could theoretically be sold, is estimated at just 400 million ounces. At a 500 million ounce annual deficit, available inventories don't last 3 years. They don't even last 1 year. The math says physical shortage hits within months. And when physical shortage hits, price is the only mechanism that can balance supply and demand. How high does price need to go to destroy enough demand to match available supply? $150 doesn't do it. Industrial demand is inelastic. Solar panels still need silver. Electric vehicles still need silver. Electronics still need silver. $200 starts to impact discretionary investment demand. But strategic government buying continues, regardless of price. Member nations need reserves, and they'll pay whatever it takes. The equilibrium price that balances this unprecedented supply-demand imbalance is somewhere between $200 and $300 per ounce. And that's assuming no panic buying, no speculative frenzy, no short squeeze dynamics. When you factor in the inevitable panic as the market realizes what's happening, $200 becomes a floor, not a ceiling. Now, let me explain why these 50 nations decided to act now. Understanding their motivation reveals why this accord will hold together and why Western institutions cannot break it. The first motivation is fair value for resources. Silver-producing nations have watched for decades as Western paper markets set prices that bear no relationship to physical supply and demand. Mexico, the world's largest silver producer, has seen its national resource sold at prices that barely cover extraction costs, while Western banks profit from derivative trading. Peru, the world's second-largest producer, has struggled to develop its economy despite sitting on some of the richest silver deposits on Earth. The suppressed price has meant suppressed royalties, suppressed tax revenue, and suppressed national wealth. These nations have finally recognized a simple truth. If you control the physical supply, you don't have to accept paper prices. You can demand fair value, and collective action makes that demand enforceable. The second motivation is de-dollarization. The Silver Accord is not just about silver, it's part of a broader movement to reduce dependence on the US dollar in international trade. By accepting silver as partial payment for exports, member nations create an alternative settlement mechanism. They reduce their exposure to dollar-based sanctions. They protect themselves from Federal Reserve monetary policy. They build a parallel financial system outside Western control. Russia's participation is explicitly motivated by sanctions. After being cut off from SWIFT and having dollar reserves frozen, Russia has every incentive to build alternative systems. Silver provides both a store of value and a medium of exchange that no Western government can freeze or seize. China's participation is strategic. They see silver as critical to their technology industries and their green energy transition. Securing supply through the accord protects their industrial base, and using silver for trade settlement advances their goal of internationalizing the yuan. The third motivation is monetary insurance. Central banks around the world are watching the same trends we're watching. They see money supply expansion. They see debt levels that can never be repaid. They see the inevitable endgame of fiat currency debasement. Gold has been the traditional central bank hedge. But gold is expensive, and most of it is already held by Western central banks. Silver offers an alternative. It's cheaper to accumulate in meaningful quantities. It has both monetary and industrial value. And it's been suppressed to levels that represent extraordinary value. The accord allows member nations to build silver reserves collectively, using their combined market power to accumulate at reasonable prices before the inevitable repricing. These three motivations, fair resource value, de-dollarization, and monetary insurance, create alignment among 50 very different nations. They don't need to agree on politics or ideology. They just need to agree that the current system undervalues their resources and exposes them to unacceptable risks. That agreement exists, and it's now formalized in the Silver Accord. Let me show you the evidence that the accord is already impacting markets. First, look at export data from major producing nations. Mexico's silver exports dropped 23% in the last quarter, compared to the same period last year. This decline came despite record production. The metal isn't leaving the country. It's being retained for domestic reserves and for sale to Accord member nations. Peru's exports to the United States fell 31%. Exports to China increased 47%. The flow is redirecting from west to east, from paper markets to physical accumulation. Russia has completely halted silver exports to non-member nations. Every ounce produced domestically is now either consumed domestically or sold to fellow Accord members. Second, look at what's happening to premiums. Physical silver premiums in Western markets have exploded. Dealers are charging 30% to 50% above spot prices for immediate delivery. Some products are completely unavailable regardless of price. Meanwhile, premiums in Accord member nations remain stable. Shanghai premiums are elevated but manageable. Indian dealers have steady supply at predictable prices. The Accord is creating a two-tier market exactly as designed. Third, look at COMEX inventory. Registered silver inventory, the metal actually available for delivery, has fallen 40% since the Accord was signed. The drawdown is accelerating. Metal is leaving Western vaults and moving east. At the current drawdown rate, COMEX registered inventory hits zero within 4 months. When that happens, COMEX silver futures become purely paper contracts with no connection to physical reality. The paper price becomes meaningless. The physical price becomes the only price that matters. Fourth, look at central bank behavior. Multiple central banks from Accord member nations have begun publicly reporting silver as part of their reserve assets. This is unprecedented. For decades, central banks held gold and ignored silver. Now they're accumulating silver alongside gold. The People's Bank of China added silver to its official reserve disclosures for the first time in March. The Reserve Bank of India followed in April. Russia's central bank has been building silver reserves since 2022, but only began public disclosure after the Accord was signed. These disclosures are strategic. They signal to markets that silver is returning to its historical role as a monetary metal. They legitimize silver as a reserve asset, and they encourage other institutions to follow. The evidence is overwhelming. The Accord is real. It's already changing physical flows, and it's creating the supply crisis that makes $200 silver inevitable. Let me show you the smoking gun that proves the Western financial establishment sees this Accord as an existential threat. Within 72 hours of the Accord being signed, something unprecedented happened in the silver futures market. The concentrated short position held by major bullion banks increased by 15%. In 3 days, the 4 largest traders added short positions equivalent to 50 million ounces. Think about what that means. The Accord just removed 71% of global production from Western paper market control. The available physical supply just collapsed. And the response from bullion banks was to add to their short positions? This is not rational trading. This is desperation. This is institutions that know they're trapped, making one last attempt to suppress prices before the inevitable repricing. They're hoping that a manufactured crash will shake out weak hands, trigger stop losses, and create enough selling pressure to buy them time. They're hoping that if they can crash the price hard enough, the Accord might fracture. But here's what they're missing. The Accord members don't care about paper prices. They're accumulating physical metal. They're building reserves measured in ounces, not dollars. A paper price crash is a buying opportunity for them, not a deterrent. When you crash the paper price to $70, China doesn't panic sell. They buy another 20 million ounces at discount prices. India doesn't liquidate holdings. They increase imports. The lower you push paper prices, the faster physical metal drains from Western vaults to Eastern reserves. The manipulation that worked for decades is now accelerating the very outcome it was designed to prevent. And here's the ultimate smoking gun. The Bank for International Settlements, the central bank of central banks, just issued an internal memo warning member institutions about exposure to precious metals derivatives. The memo specifically mentioned silver and recommended reducing concentrated positions. Let me translate that for you. The BIS just told bullion banks that their silver shorts are a systemic risk and they need to get out, but they can't get out. Closing a 350 million ounce short position requires buying 350 million ounces. That buying pressure would send prices vertical, and there isn't 350 million ounces of available inventory to absorb the buying anyway. They're trapped. The Accord has removed the physical supply they needed to perpetuate the suppression. The BIS is warning them about systemic risk, and every attempt to crash the price just accelerates the drainage of Western inventories. This is checkmate. They just haven't admitted it yet. Now, I know some of you are skeptical. You're thinking that commodity accords have been tried before and they always fail. You're thinking that Western financial power will find a way to break this alliance. Let me address these objections directly. Objection 1, OPEC-style cartels eventually break down due to cheating. My response? The Accord is structured differently than OPEC. It doesn't require nations to restrict production. It only requires them to prioritize sales to member nations and to build strategic reserves. There's no incentive to cheat because there's no production quota to violate. Every member benefits from higher prices and secure supply. The alignment is natural, not forced. Objection 2. Western nations will sanction Accord members. My response? With what leverage? The Accord includes China, Russia, and India, 3 nuclear powers representing over 40% of global population. It includes Mexico, America's largest trading partner. It includes OPEC nations that control global oil supply. The West cannot sanction half the world without destroying its own economy. Objection 3, silver supply will increase to meet higher prices. My response, mining supply cannot increase quickly. Opening a new silver mine takes 7 to 10 years from discovery to production. Higher prices will eventually bring more supply online, but not for nearly a decade. In the meantime, the deficit persists and prices rise. Objection 4, recycling will increase supply. My response, silver recycling is already near maximum efficiency. Most silver used in industrial applications is consumed in such small quantities that recycling is not economical. The scrap supply is inelastic to price. Higher prices won't significantly increase recycling flows. The objections are understandable, but they don't change the fundamental mathematics. 50 nations, controlling 71% of production, have decided to stop accepting paper prices. The physical flows have already shifted. The inventory drawdown is already happening. $200 silver isn't a hope, it's arithmetic. Let me give you a framework for navigating this unprecedented situation. First, understand that the Accord accelerates the timeline. Before the Accord, the silver repricing might have taken 5 to 7 years. The Accord compresses that timeline dramatically. Physical shortage could manifest within months, not years. Position yourself accordingly. Second, prioritize physical metal. In a world where paper markets are disconnected from physical reality, owning actual metal is essential. ETFs carry counterparty risk. Futures contracts may not be deliverable. Physical silver in your possession has no counterparty risk and cannot be defaulted on. Third, understand the two-tier market dynamic. Western spot prices may remain suppressed longer than fundamentals suggest because paper manipulation can continue even as physical supplies drain. Don't mistake low spot prices for low value. The premium is the real signal. Buy physical at whatever premium is required. Fourth, watch for the breaking point. There will be a moment when paper and physical prices permanently diverge, when COMEX defaults on delivery, when dealers stop posting spot-based prices, when silver simply becomes unavailable at any paper-quoted price. That moment is approaching faster than most realize. Fifth, think strategically about jurisdiction. Silver stored in Accord member nations may become more accessible than silver stored in Western vaults. Diversification isn't just about asset allocation. It's about geographic and jurisdictional diversification. Consider where your metal is held, not just how much you hold. The Accord has changed the game. Old strategies for precious metals investing may not apply. Adapt your approach to the new reality. Here's my question for you, and I want this discussion to explode in the comments. Do you believe the Silver Accord will hold together? Do you think 50 nations with competing interests can maintain coordination long enough to break Western paper market control? Or do you think the Accord will fracture under pressure? Your perspective matters. This community has insights that often surpass mainstream analysis. Share your view. Challenge my thesis. Let's stress test this analysis together. Drop your thoughts below. And if you're already adjusting your precious metal strategy based on the Accord, share what you're doing. Your experience helps everyone watching. Let me leave you with the most important point. The Silver Accord represents the most significant shift in precious metals markets since Nixon closed the gold window in 1971. 50 nations have decided to stop accepting paper prices for their physical resources. 71% of global production is now under coordinated management. Strategic reserve building is adding hundreds of millions of ounces of new demand. The mathematics are undeniable. Demand now exceeds supply by 500 million ounces annually. Available inventory depletes within months. The only mechanism to balance supply and demand is price. $200 silver is not a prediction. It's the mathematical outcome of the Accord's implementation. And if panic buying, short squeezes, or a monetary crisis accelerate the timeline, prices could far exceed that target. This is Finance Reborn. 50 nations just signed the Silver Accord. The paper market suppression is ending. The physical market is taking control. And $200 silver is no longer a question of if, but when. If this breakdown helped you see what's really happening in global silver markets, hit that like button, subscribe to the channel, and share this with everyone who needs to understand the historic shift that just occurred. Stay sharp, accumulate physical, and I'll see you in the next one.